Hi everyone, in this video we are going to continue analyzing the hypothetical company ABC Inc. We started analyzing in the previous videos. This time we are going to specifically look at closing entries. We have 6 closing entries that we are going to cover. The first one is incurring $3,000 of rent expense. And whenever we incur an expense, retained earnings is going to decrease by 3,000. And if you haven't watched previous videos, I highly recommend watching those videos because this is building on top of the previous videos. So as you may remember, in the previous video we had prepaid rent. We prepaid rent previously. Now time passed by and we are going to record that decrease. So prepaid rent is going to decrease by 3,000 and this becomes the rent expense. So my rent expense is going to decrease my retained earnings, and at the same time my asset called prepaid rent is going to decrease by the same amount. In transaction number 2, salaries in the amount of $1,500 were earned but not paid yet. So whenever I incur an expense, retained earnings is going to decrease. Retained earning decreases in 2 scenarios: whenever there is an expense, which is wages expense in this case, or when there is a dividend. So those are the 2 cases where retained earnings decrease. And I have not paid these salaries, so I'm going to record that as a liability. So what's happening in this case is when I incur an expense, when I recognize an expense, but if I don't pay it, I'm going to reduce my retained earnings and I'm going to record that as a liability. And then in transaction number 3, we are seeing that inventory count shows that there is $4,000 worth of inventory left. If you remember from the previous videos, inventory that we bought was $5,000. Now we are told that the inventory decreased to $4,000. In order this to happen, we need to have $1,000 worth of crediting in the inventory account, meaning we sold inventory worth $1,000, and that's when we sell the inventory, it's going to decrease retained earnings as an expense, and the expense type is specifically called cost of goods sold. Cost of goods sold is going to decrease retained earnings, and my inventory is going to decrease by 1,000. I don't need these numbers here. I just want to show you that it's decreasing from 5,000 to 4,000. So the actual entry is a decrease of 1,000, and correspondingly the expense, specifically cost of goods sold, is $1,000. These are the first 3 transactions. The next 3 transactions I will be recording in the next video, and then after that we are going to start building our income statement and balance sheet.